earn even $1 of foreign income before you land in Canada, and a rule called the 90% rule can quietly cut your first-year federal basic personal amount from $15,704 down to as little as a few $100s per CRA newcomer guidance. That single technicality can cost you over $3,000 in extra tax and lost benefits, depending on your province and bracket. I read the fine print so you don't have to. Let me show you exactly how this rule decides your very first tax break, and why so many newcomers trip over it. Here's the simple version. In your first or last year in Canada, you only get your full federal non-refundable tax credits if 90% or more of your income during the non-resident portion of the year was from Canadian sources according to CRA. Think of it like a scholarship with an attendance clause. Miss the threshold by a hair and you don't lose part of the award, you drop into a completely different and smaller tier. That sounds simple, but the way CRA measures it is where people get burned. The first thing to understand is that CRA doesn't treat your arrival year as one block. It splits it into two: the resident period after you arrive and the non-resident period before. Think of it like a phone bill split across two plans mid-month. The system charges each half under different rules, and you have to justify each half separately. Your credits for the resident period come from the days you lived here, but your credits for the non-resident period hinge completely on that 90% test. The test itself is one line of math. Take your Canadian source income for the non-resident period, divide it by your net world income for that same period, and multiply by 100, exactly as CRA's worksheet does. Think of it like a purity test. CRA is checking what fraction of your pre-arrival income was made in Canada, and it needs to be almost all of it, 90% or higher, and you're treated like a full-year resident for credits. Below that, and the machinery flips against you. Now here's what failing actually does. Instead of full credits, CRA prorates them by the number of days you were a tax resident, according to their guidance. Think of it like a gym membership charged only for the days you showed up. Except in this case, arriving mid-year means you get personal credits only for those partial months, while your worldwide income still counts. That prorating hits your basic personal amount, your spousal amount, your age amount, all the big personal credits at once. Let's make this concrete with Anna, a software developer. She earned $35,000 in Brazil from January to May, then $55,000 in Ontario after arriving June 1st. For her non-resident period, her Canadian income was zero, so the formula is 0 divided by $35,000, which equals 0%. An automatic fail under CRA's method. Think of it like a scoreboard reading nothing to nothing. Even a full foreign salary scores no Canadian points. So her basic personal amount gets prorated to roughly $9,214 instead of the full $15,750, based on 214 days of residence out of 365. And here's a layer most people miss entirely. The province follows the same logic. Anna's Ontario basic personal amount, which was $11,341 in 2022, gets prorated down to about $6,132 across her 214 days of residence. Think of it like a corked bottle spilling twice, once federally, once provincially, from the same single crack. At a combined provincial rate in her bracket, that's roughly another $460 to $610 in extra tax she never saw coming. If this is useful, subscribe. The next breakdown is already coming. Before I get to the last part, which is the most counterintuitive piece of this whole rule, there's a trap that catches even people with no foreign income at all. For years, guides said that if you reported zero income before arriving, you automatically passed. Think of it like a door that used to open when empty, and now stays locked unless you show up carrying something Canadian. CRA has quietly changed how it reads that, and it's reshaping thousands of first-year returns. Here's the catch that reverses old advice. For 2024 and subsequent tax years, CRA now treats a part-year resident with no world income during the non-resident period as failing the 90% rule, according to a major tax software provider's summary. The math becomes 0 divided by anything, which equals 0, a fail. Think of it like a bank that no longer counts an empty account as being in good standing. So even someone who only worked after arriving in Canada can now see their credits prorated. And the strangest part, you have to report the very foreign income that Canada won't even tax you on. Newcomer guides are clear that pre-arrival foreign income must go on the 90% worksheet, and it's exactly what can drag your Canadian percentage below the line. Think of it like declaring items at the border you won't pay duty on. The declaration itself changes what you qualify for. A weak first return can also cost you the GST/HST credit, up to $400 for singles, and the Canada Workers Benefit up to $1,518 for individuals, per Newcomer guides. So what does it mean for you? For Anna, the modeling adds up fast. Roughly $1,330 in extra federal tax, around $500 more provincially, and up to $1,885 in missed GST, HST, and workers' benefits, near $3,800 in her first year alone, based on CRA and Newcomer guide figures. Think of it like a compound interest mistake in reverse. One filing choice can echo for years because a weak first return can also shrink income-tested supports down the line. Over a career, a modeled version of that gap can approach $10,000. Here's what to actually do. First, run CRA's 90% worksheet before you file, using every source of pre-arrival income, Canadian and foreign, so you know your real ratio. Second, report foreign income accurately even though Canada won't tax it. Leaving it off is what triggers later reassessments. Third, log into CRA My Account after filing and confirm your GST, HST credit, child benefit, and workers' benefit match your situation. Think of it like checking the fine print before signing. 5 minutes now can save a costly reassessment later. The 90% rule is a cliff, not a slope. Crossing below 90% Canadian source income in your non-resident period can instantly erase thousands in credits and benefits. Next, I'm covering how the Canada Child Benefit is actually calculated for newcomers and why your first return sets years of payments. If you want to catch that, subscribe so you don't miss it.